I want to welcome on today's guest. Joining us on the show once again, Samantha LaDuc. Samantha is the founder of LaDucTrading.com, comes to us from Massachusetts. Samantha, welcome back to the show.
Thank you so much.
So, Samantha, you always do a great job of sort of helping us understand the macro environment, the big picture with a great technical overlay. And I love the charts that you bring with you. We're starting looking at a long-term view of 20-year yields. Interest rates certainly a big part of the story with a lot of movement now. What is your toolkit telling you?
Well, I've talked with you in recent past about my theme since last summer of things over paper. It is very much that kind of growth to value, value to growth rotation, which I really focus on for clients, basically timing the sector rotation. And right now we're still very nicely in this theme of inflation, and it's sticky. I'm not upset about that. I think there's some wage inflation, but there's also asset inflation. And it's, for right now, the reason that we spend so much time talking about interest rates and Fed taper and in the rest to determine what monetary tools are going to be thrown at the market for these inflection points. And I think it's been a dollar short conversation we've had since August of last year. That continues to play out. Dollar has been doing okay, and everyone is really focused on Jackson Hole come August and then September, and all kinds of announcements about, raising rates as well as tapering. But for me, it's just not the mantra that I'm on. I still think we have more digestion. This is one chart that kind of shows me in the 20-year Treasury yield that we could have some very higher yields in the future, but for right now, they're doing a really good job of creating potentially that right shoulder. All bets are off if it breaks the neckline, right? But you can also see from the lower panel that rate of change has been very, very firm. So unemployment rate still needs to drop from its 5.4% right now to near 4%, the pre-COVID, and stay at or below it for really a convincing period of time in order for the labor market to be at the pre-pandemic levels and for that Fed tapering to really ramp up. Lots of Fed heads are coming out talking about, the train of its time, but ultimately it's just, I think it's a little bit too soon. I think we have some time, some period of digestion.
Very, very interesting. Chart number 2, Samantha, is a ratio that I think speaks to that things over paper thesis you were sharing. Talk to us about chart number 2.
Well, this is very much this theme of yields rising help that reflation trade. And even though we have stagflation in large part with rising prices and lots of money chasing fewer goods, the point of the matter of this particular ratio chart, and by the way, that has popped up to about point, I don't know, 8 the past few days, is that it's a really good tell for the inflation bait with commodities. So for trades, it's great to kind of basket trade. I mean, energy still leads, interestingly enough, this year for sector returns. It's up 33%, even though it's been languishing for months, right? Sideways. Real estate comes in number 2. Financials at number 3, up 30%. Communications. Tech is number 5. So even though there are pockets, of course, always in tech, this lovely play of, earnings expansion for cyclicals is still, I believe, great value going into 2022. We're literally, companies are guiding 20% higher for 2022 in the cyclical corp space. Stocks will trade up. The New York Stock Exchange has just broken out recently, which is very supportive for small caps, especially IWN, which is the value plays, SPHB, which is the value. We just got some really nice breadth and cumulative volume impulses this week in response to the fiscal infrastructure bill that's being pushed really hard and growing. I think it's actually very supportive for yields down the road.
It's a great set of charts and a well-articulated thesis, Samantha. And you're certainly seeing the strength now of some of the cyclicals that have been have been pulling back a little bit, right? Things like energy that you mentioned and others, materials all rotating to the upside. So when you think about, we just have about 30 seconds left. When we think about between now and year end, I think I know your answer, but where would you be looking opportunistically? What are things that are not overextended that you think have the best opportunity to benefit from this sort of scenario? Any particular
Oh, there
sectors or
are,
themes that
yeah,
you think make sense?
there are still commodities and cyclical and value plays that have been tracking on a weekly chart. They're 10-week very, very well. They have pulled back. They're now in the process of trying to break out again from coal, natural gas. Just there's a whole bunch. It caught me kind of off guard. I have a long list, actually, of what I call the safety plays,
Sure.
because they don't
Sure.
move like hot fire flames like tech. But they're absolutely grinding higher and a really nice value for doubling into the next year or two.
Samantha, it's fantastic to speak to you. As always, you bring a lot of great content and ideas with you. Hope you stay safe. Be well. We'll talk to you again soon.
Thank you so much. Happy summer.
You too. That's Samantha LaDuc. Samantha's the founder of LaDucTrading.com based in Massachusetts. And I love the two charts. And again, what I love the most about them is the time frame. When we talk about this environment right now, we talk about, the performance of cyclicals or growth versus value, small versus large. It's so easy to get drawn into the short-termism of all of it, right? Just thinking of this week or this day and what it means. And what we try to do and what I'm thankful of when we bring someone like Samantha on is she shows you sort of the long-term trajectory and helps put a proper long-term perspective on some of these movements that we've had. Things like higher rates. I've mentioned it probably before. There's no doubt in my mind that rates are going to be materially higher than they are now at some point down the road. The question always is how we get from point A to B, and it's rarely in a straight line. It's usually fits and starts, or what, from a technical perspective, I call impulse and then corrective waves to get there. But I love the chart of the 20-year yield to sort of put that long-term trajectory into proper perspective.